The traders at Axis Bank say they expect the bearish sentiment witnessed in the Treasury Bills market to persist, despite the 50 billion CNBC auction by the Central Bank of Nigeria. Kinskin Ukeje, FX dealer at Axis Bank, joins me for a weekly wrap of activities at the Nigerian Fixed Income and FX market. Kinskin, thank you for taking time out to join us today. Let's get right to it. Bring us up to speed on trading so far today across the different market segments.
Oh, thank you for having me. Trading so far today will be on a bearish note, as market participants will be on the sell-off to fund for the retail auction, which will be holding on the FX space. The CBN is going to conduct the bi-weekly retail SMS auction today. The market liquidity in general this week has been tight after resuming at 26 billion earlier in the week on Monday. We saw a credit of 100 billion in normal maturities, but this was taken out by Wednesday with a 200.5 billion auction for bond auction winnings on Wednesday. Coming into today, we saw the market open at a ripple of about 115 billion, so the market is quite tight, and the traders will be doing a lot of sell-off to fund for the retail auctions.
Now, for the CBN, for the CNBC auction, I believe that was yesterday, the CBN decided to maintain rates at the auction, and we're told that no sale was recorded. Can you confirm this and just shed more light on this for us?
Yeah, we confirmed the CBN floated a 50 billion auction across the 92, 196 and 362 days maturity with no sale yesterday. This was we do not certainly know why, but we can attribute this to the wide bid range and also the low liquidity in the market.
Now, talk to us about the yield curve. We did see, I believe it was in the bond market, we did see sell-offs on the long end of the curve, but I know that there's been that gradual climb in yields, both the short and the long end, because obviously investors are demanding more to hold on to government securities. Talk to us about that and how much higher, how much room do you see upwards in terms of how high rates can go?
Yeah, we will continue to see that upward trajectory in the bond market. And what we saw this week was a lot of supply when compared to the demands in the market. So we've seen the auction bonds and the 20-year reopening increase to 14.20% from where it closed at 14% in the bond auction on Monday. We should still see that upward trajectory going on.
All right, let's quickly go back to the FX market. I wanted to talk to you about the NAFEX rate. I believe it was earlier this week where we did see it weaken to 430. That was at the INE window, I believe, and NAFEX somewhere around there. Is the Naira still hovering around those levels? And I was just taking a look at the FX reserves, which is somewhere around 38.8 billion. So talk to us about the rates where they are at around 428, 430. Do you see the Naira maintaining rates at this level, or do you anticipate further weakening?
Yeah, currently at the FX market, we've seen it settle off around 427 to 430 levels. We've seen the FX reserves also close at 38 billion. What we have seen in the market is that the CBN has continued to sustain demand, supply in the SME and the invisible space. However, to the FPI, as we've seen a halt in that intervention. The NFX is just settled. I think the market has capped at that 430 levels at the moment. We should see how the market pans out in the coming months.
Well, let's talk about your forecast for the coming week. What can we expect in terms of investor sentiments at both the bond and the NTB segment of the market?
Yeah, for the bond and NTB segments of the market, we should still see the bearish sentiment because markets will be funding their various obligations. Market participants will be funding their various obligations because the liquidity in the market is quite thin. Currently, where market is in a ripple compared to the retail auction that will be held today. They should take out more from the market liquidity and should sink market into a ripple the more. So next week we should see more sell-offs to fund obligations in the market.